let's just talk about the trade management for a minute. And for the option trades, the goal with the trade management is to exit losing trades quickly, and we don't want to exit our winning trades with a small gain. So if you hold on to the losing trades and you exit your winning trades with a small gain, you're eventually going to wind up with a losing portfolio. So we want to practice this discipline of exiting these losing trades quickly and holding on to our winning trades. And we also, part of our trade management is if we have a profit in an option, then we want to protect that profit, and we create a spread trade that helps protect the profit. So we have 3 money management rules. We use a stop loss rule of 20%, and we'll also roll over at option expiration if the stock is still on a buy signal. In this case with ETF, if it still has a high relative strength and the trade is profitable, then we'll roll over the option at option expiration. And then we also have what we call the 30% rule for protecting profits, and whenever we have a profit, we want to create a spread trade. So let's talk about the first trade management rule, which is the 20% rule for walking away. And the goal of this rule is to prevent a small loss from developing into a big loss. And if an option's price drops 20% below our entry price, then we simply want to exit the trade. And we definitely want to be out before it reaches a 30% loss. So when you get out with a 20% loss, this helps prevent a 100% loss potential in the trade. So we want to practice this discipline of exiting these trades quickly if we're wrong, and sometimes we are wrong. And again, just as an example, we bought the dividend ETF 70 strike call at 1170. So in this trade, if the price of the option drops 20% to around 936 on a closing basis, then we'll simply exit this trade, and this helps prevent a total loss of the option premium and allows you to stay in the game. So you want to exit these losing trades before they develop into big losing trades. So if you incur a 20% loss on a trade, it only takes a 25% return on the next trade to break even. So let's say we have a bad timing on our entry, and we take our 20% loss on our option premium, and then we go into the next opportunity. We only have to get a 25% return on that new opportunity to break even from this 20% loss. But look what happens if you hold on to that losing trade and you incur a 50% loss. Then it takes a 100% return on the next trade to break even. So we don't want to take these big losing trades because it's really hard to make up for these losing trades. So a 50% loss, the next trade, you have to have a 100% return to break even. So how many 100% wins have you had lately? So my point is we want to exit these trades before they develop into big losses. And if you take a 75% loss on a trade, the next trade has to have a 300% return just to break even. So we don't want to take these big losses. So we'll take a 20% loss, and then we move on to the next opportunity, and that's all part of the trade management. And then another trade management rule we use is we roll over at option expiration if the ETF is still on a buy signal and the trade is profitable. So when we roll over our profits into the new trade, then that reduces the risk and allows us to compound our returns and allows us to play with the house's money. So once we enter these trades and we start to profit and we start rolling over, a lot of times it only takes 2 or 3 rollovers, and we'll reduce our risk to zero on the cost of the option. Of course, then we have no risk at that point. Here's some examples of rollovers. This is for the QQQ NASDAQ index, the VNQ Real Estate Investment Trust index, Consumer Staples Index XLP, and Utilities Index. And these are just examples of rolling over the profits from the option that's expiring into the new trade. So with the QQQ, we had a $509 profit. With the VNQ real estate, we had a $319 profit, $216 profit for the XLU. So when we closed out the expiring option, then we rolled over those profits into the next option. So in the case of the XLU, we had a $216 profit. So we closed out the April call with a $216 profit. Then we bought the September call at $690, but the $216 profit reduced that new cost from $690 to $474. So what that did is it reduced the risk by 31%, because our new cost is $474 at risk instead of $690. So this reduced the risk of the new trade. Here's another example. The QQQ, we had a $509 profit. The September 100 call cost $1288. So if you subtract that profit from the new option cost, then we have a reduced cost basis of $779. So this reduced our risk by 40% on the new trade. So we like to do that, and we typically, after 2 or 3 rollovers, will reduce our cost base to zero. So again, rolling over options reduces the risk and allows us to compound our returns, and a lot of times we can reduce that risk to zero, and then we start playing with the house's money.